Hello everyone, and welcome to today's webinar. I'm Ellie, PR Manager of InfoLink Consulting, and I'm excited to be here today as we dive into India's evolving solar and energy storage markets. For those who may be new to InfoLink, we are a leading provider of renewable energy research and consulting service. Today, we will be discussing what awaits in 2025 for India's renewable energy landscape. As you may know, India has set ambitious targets, aiming to achieve 500 gigawatts of renewable energy capacity by 2030. This target has driven the solar market development, with initiatives like Production Link Incentive Scheme providing a much-needed boost for local manufacturing and reducing the country's dependency on imports, especially from China. Alongside this, energy storage is becoming increasingly crucial as India seeks to stabilize its grid and integrate more renewable energy into its system. Over the next hour, we will explore these trends in more detail, including challenges in the solar supply chain, the shift toward larger energy storage solutions, and the potential investment opportunities. We will also touch on how these developments could impact business and stakeholders, both locally and internationally. We are lucky to have three experts with us today who will share their perspective. Jonathan Zhou, our research assistant, will kick things off with an overview of India's solar markets, touching on global trends, installation progress, and the policies driving this growth. Ellen Tu, our solar analyst, will take us deeper into India's PV supply chain, covering supply-demand dynamics, the impact of the Chinese supply chain, and what opportunities lie ahead in 2024 and 25. Robin Song, our energy storage analyst, will talk about India's energy storage markets, exploring supply-demand, pricing, investment opportunities, and collaboration possibilities for both local and international players. In addition, we will run a Q&A section at the end of today's webinar. This will be moderated by our Chief Analyst, Corinne Lin, who brings years of experience and a wealth of knowledge about renewable energy markets. Corinne will guide the discussion and ensure we answer your questions. So feel free to submit your questions during the session via the chat box. We are hoping today's session will equip you with valuable insights to help you navigate India's evolving energy landscape and position your business for long-term success. Once again, thank you for joining us today. Let's begin with Jonathan's presentation on India's solar markets.
Hi everyone, I'm Jonathan Zhou. Thank you all for being here. Today, I'll be discussing update on India's market trend, policy framework, and technological advances. Today, I'll focus on analyzing India's solar policies and market demand, but my colleague Ellen will share insights on India's production capacity and the supply chain. My presentation today will be divided into three parts. First, we'll look at the current state of the global solar markets and provide our forecast for major markets in 2025. Next, we'll look into India's solar policies and how these impact its market. Finally, we'll wrap up with a conclusion. So, let's start with an overview of the global solar market for 2024 and our demand forecast for 2025. First of all, because of the slowing economic growth and increasing policy uncertainties, we expected that global market growth in 2025 to be slower than in 2024. Starting with China. It's clear that China remains the largest solar market in the world, but in 2024, some challenges have emerged. Issues with land approval in certain areas have delayed project installation. Also, rising land costs and rooftop leasing costs have discouraged solar demands. Due to these challenges, the market is showing signs of cooling down. As a result, China's demand in 2025 is expected to stay steady at around 245 gigawatts to 265 gigawatts, quite similar to 2024. Moving on to Europe. Economic growth has been slower this year. High financing costs and insufficient grid capacity have delayed the installation of many projects. There is also the possibility of changes to the subsidy policies in many European countries, which might reduce public interest in solar installations. Therefore, we expect demand growth in Europe to also slow down in 2025. And next, US market. Several trade policy adjustments for solar products have been made in 2024, including the removal of the 201 tariff exemption for bifacial modules and increase in sales import quotas, an increased tariff rate in the Section 301 tariff. Additionally, there has been recent anti-dumping and countervailing duty investigation on solar products from Southeast Asia. To sum it up, we still need to see how these trade policies will affect the US market policy. On the other hand, the industry is evaluating the Trump administration's stance on renewable energy, especially whether subsidies under the IRA Act will persist or not. So, given the uncertainty of policy impacts, expected that the US market will also continue to grow steady next year. And next, let's talk about Brazil. In recent years, Brazil has benefited from falling module prices and low interest rates, as most of its installations rely on imported modules. However, in the second half of 2024, the local government raised tariffs on modules and reduced tax exemption quotas. As a result, we expect Brazil's demand to decline next year. Finally, India. While growth is slowing in other major markets, India is emerging as a bright spot, with global solar demand expected to grow by just 5 to 7%. India's market is set to expand significantly, with demand projects to hit 25 to 35 gigawatts in 2025, a potential growth of 25 to 40%. Now, let's take a closer look at India's solar market. India has been actively advancing its energy transition in response to the global net zero trend. As of 2023, renewable energy accounts for over 30% of the total energy capacity, a significant increase from less than 20% in 2017. Also, India has set ambitious targets in its National Electricity Plan, NEP aiming for cumulative renewable energy installations of 337 gigawatts by fiscal year 2027 and 596 gigawatts by fiscal year 2032. This means India government wants to double its renewable energy capacity in just a few years. And as you can see in the chart, solar energy in particular has become the leading renewable energy in India, growing from just 5% of total capacity in 2017 to 70% in 2023. As of September 2023, India's cumulative solar capacity reached 90.8 gigawatts, with 70 gigawatts from ground-mounted solar projects and 14.3 gigawatts from rooftop solar projects. This marks a rapid growth over the past decade, with a CAGR of 29% from March 2015 to March 2024. And to meet the NEP targets of 185.6 gigawatts by fiscal year 2027 and 364.6 gigawatts by fiscal year 2032, India's solar CAGR needs to jump to 46% at least, requiring annual PV installations of at least 35 gigawatts. To make this happen, India really depends on having the right policies in place. Now, let's take a closer look at India's solar policy. I'll divide these policies into two types, demand side and supply side policy. Demand side policies mainly involve government incentives such as large project tenders and subsidies, which help drive the growth of solar demand. Supply side policy, on the other hand, include policies like import tariffs that encourage domestic manufacturing capacity. So, starting with the demand side. The first is the rooftop solar scheme. This program provides subsidies for users to install rooftop solar projects and set a target for cumulative rooftop solar installations to reach 40 gigawatts. But in February 2024, the India government modified the scheme into PM Surya Card, which offered more subsidies and simplified the application process. Next is the development of solar parks and ultra-mega solar power projects. As the name suggests, this program focuses on large-scale ground-mounted solar projects. Offering tenders and subsidies, the policy's target is to add 40 gigawatts of solar installations. By 2023, around 38 gigawatts have been auctioned under this policy, making a key driver to India's large-scale solar installations. And then, the Central Public Sector Undertaking, also known as CPSU scheme. It is aimed at government departments or government enterprises to build solar projects, including install solar system on public sector buildings. This policy aims to add 12 gigawatts of installed capacity. Finally, there is PM cusp, which seeks to ensure energy access for agricultural land through solar power. The policy also provides subsidies for the installation of solar power system on farmland and solar power irrigation pumps. This policy aims to add 34.8 gigawatts of solar capacity. Together, these four demand-side policies provide a total amount of 170 gigawatts in new solar installation targets, and all of them with a policy deadline in the fiscal year 2026. To meet this target, significant growth in demand is expected in 2024 and 2025. On the supply side, starting with a domestic content requirement. This policy promotes the use of Indian-made modules assembled with Indian-made cells. As mentioned before, in the demand-side policy, like PM Solar Card, CPSU, and PM cusp, all mandate the use of DCR modules. However, compared to module capacity, India currently lacks of sufficient domestic cell production, which could potentially hinder the growth of India's solar demand. Next is the safeguard duty tariff in the past and ongoing passing custom duty. At that time, when the price of solar products were relatively high, import tariffs certainly impact India's solar demand. However, with the decline of the global supply chains prices in 2023 to 2024, the negative impacts of the obesity tariffs has gradually been offset. Moving to the production link incentive scheme, which has already conducted 2 bidding rounds. A total of around 48 gigawatts of capacity is expected to be built over the next 3 to 5 years. By around 2026, this policy provides significant incentives for local manufacturing capacity. Finally, in September, India launched an anti-dumping and countervailing duty investigation into imported cells and imported modules from China, with a primary determination expected in December. If the tariff are imposed, it could increase project costs in India. However, India had previously initiated AD/CVD investigations against Chinese solar cells and modules before, which were ultimately not implemented. Therefore, the future of this policy remains uncertain. We have to keep monitoring its progress. And then is LMM, approved list of modules and manufacturers. This policy requires government projects to use modules in the LMM list. Due to the insufficient module capacity, implementation was postponed for a year in 2023, but is set to be implemented again in 2024. It is important to note that while LMM accepts applications from foreign products, the latest list published in October includes over 60 gigawatts of module capacity, but all of them modules are made in India, not from foreign countries. But 60 gigawatts of module capacity in local is enough to meet India's market demand. And last, the MRE has announced that by 2026, an LMM cell list will be implemented, meaning that in the future, government projects will not only need to use modules from the LMM list, but also cells from the LMM cell list. The LMM re-implement led to a rush of installation in March 2024, about 6.2 gigawatts, as you can see in the chart. And by Q2 2024, module imports dropped 83% quarter on quarter, while cell imports rose over 15% quarter on quarter. It shows that India's solar market now relies increasingly on local modules using imported cells. And in the long term, India's push for local manufacturing through policies like LMM and DCR requirements may further reduce reliance on foreign solar cells and solar modules. At this point, whether India's domestic capacity could be commissioned in time, especially in cell manufacturing, will be a key factor in the future of the Indian solar market. And last, let's conclude the opportunities and challenges for the future growth of India's solar market. First, the opportunities. First one is policy benefits. Like we said before, various demand-side policies provide growth momentum aligning with supply-side policy that boosts local manufacturing. The Indian market supply chain is gradually improving, showing its vast potential in solar energy. And next, global supply chain price drop. Price decrease across the solar supply chain in 2023 to 2024 drove down project costs, which will help boost demand in India. This is especially beneficial for Indian manufacturers or project developers using imported cells or imported modules, as adverse impacts from the trade barriers like BCD tariffs are gradually being offset, like we mentioned before. And next, significant energy transition demand. With economic growth within the large demographic dividend, India's energy transition trend will drive the installation of larger solar project cells. This will not only meet the future of electricity demand, but also achieve the policy goals of NEP. Next is potential risks. The first one is policy uncertainty. The implementation methods of several policies remain unclear, such as the application of disbursement methods of subsidies in some government programs, such as PM Solar Car and the PM Cushion, and the exemption criteria for project following the implementation of the LMM list. These factors cause considerable uncertainty for manufacturing and project developers. And next, capacity expansion lags behind demand growth. Given the above policy uncertainties, also India is actively promoting supply-side policy like DCR and LMM. The key to the development of the India solar market hinges on whether domestic capacity, especially cells, can be commissioned in a time to meet continuously growing local demand. And last, insufficient grid capacity. This is also the common issue that many countries are currently facing. Due to the outdated grid infrastructure and facilities in some regions, issues like unstable power generation and delays in grid connection rise, affecting investment returns for project developers. In the long term, this will hinder the development of the solar market on the other hand, it also provides opportunities for local energy storage projects. And that concludes my presentation today. Thanks for listening.
Hi everyone, good afternoon folks from India. I'm Alan, a solar analyst at InfoLink Consulting. Here I'll be talking about the evolving landscape of India's solar market as we move through 2025. And since the India market is still closely tied to what's happening in China, the first part of today's presentation, I'll cover the current trend in China and how it is impacting India. In the second half, I will dive into the current status of Indian PV supply chain, along with the future outlook and opportunity for this market. So in our earlier slides, Jonathan has just provided a comprehensive overview of India's impressive performance over recent years. Driven by supported government policies, the demand for solar in India is growing fast. At the same time, with a mix of incentive and regulations, a carrot and stick approach, the local manufacturing capacity is also expanding rapidly. To get a sense on how the Indian market ranks globally, we can take a look at this quadrant chart here. The horizontal axis shows the annual growth rate for 2024 and 2025, and the vertical axis represents the market size. So, where is India? You can see it is out there. India is projected to keep up the strong growth through 2025, with the growth rate increased from 11% to 25%. And also, the market size is expected to reach 25 to 35 gigawatt in next year, placing India among the top 5 markets, a position that cannot be ignored. And without further ado, let's go straight into what's currently happening in Chinese market. I'm sure everyone here is aware that the supply chain prices keep dropping, and nowadays the China produces around 80 to 90% of the global supply across the whole supply chain, from polysilicon to module. Any movement in China makes a huge impact worldwide, and especially in India. And right now, Chinese market is facing unprecedented challenges. Before 2023, the growth in China was limited by the shortage of polysilicon, pushing the price up to 300 RMB per kilograms, a staggering 8 times higher in current level. The high profitabilities in polysilicon and wafer sectors in the past, it attracted a rush of manufacturers to expand capacities. As new expansion plan and new production line gradually came online, by the end of 2023, the supply chain has fully established, with no shortage remain. And even today, effective capacity across all 4 sectors has surpassed 1 terawatt, way higher than the global demand. Even this year, our calculation shows a supply-demand ratio reaching 2.5%, which is a record high. And because of this, the industry is now going through a period of chaos and consolidations. When I was back in REI in October, many of you asked, when will this end and when we can see the balance in the solar supply chain? As we are actively tracking production and effective capacity for every single manufacturer, I have to say, without strong central government intervention, the capacity reduction are processing much more slower than the government expect. In many cases, the capacity is backed by the local government support, which is why it is not surprised that the honorary chairman of the CPIA, China PV Industry Association, he recently called out that in the development of our PV industry, the local government has become too deeply involved, turning many PV projects into performance-driven endeavor, which makes it very difficult for this project to be phased out. So that's why, looking ahead to 2025, we don't foresee a return of balance in supply and demand anytime soon. I know that many of you are looking for the supply chain price trend, which is one of our strengths at InfoLink. But before we dive into the outlook on future pricing, I would like to take a moment to highlight the bottleneck the Chinese manufacturers are currently facing and set our tone for the future price outlook and forecast. Here are the cost structure and profitabilities for the Chinese manufacturers. We can see that across the entire supply chain, from polysilicon, wafer, cell to module, players in each sector are facing significant losses. And due to the oversupply in Chinese market, the competition has intensified into a certain level, where manufacturers are forced to offer lower price that undercut the market. And this kind of competition has led to significant losses. And we can see that nearly every solar manufacturer, they have posted unprofitable Q3 earnings in this year. And especially for the module sector, companies only have small margin when they are selling to European or maybe to other overseas markets. And of course, this is not a fairy tale for all module manufacturers, all module players. The ones who do not have overseas channel or strong bank capabilities are struggling to achieve profitabilities. It is because they have to sell at even lower price to remain competitive. And for everything that we have covered so far, I think we have a clear picture now. Looking at the price trend across the 4 sectors, apart from module, there's a very little room left for the further price drop for polysilicon, wafer, and cell. Well, we have said this before, but I would like to say it again. The current situation is by far the most critical, and it is not likely for the price to drop even much more deeper. Many manufacturers are facing layoffs and production cuts due to the falling supply chain price. The wafer and cell production are now operating utilization rate around just 40 to 50%, and even polysilicon production is seeing cutback and shutdown, which is really rare in this industry. So in the end, here comes to the questions. When will the price recover and when we can see the price rebound? And because of the environmental constraint that we have just mentioned earlier, we believe that the capacity phase-out will be very slow, and the module price are likely to hover at the bottom throughout 2025. And of course, what's special for this industry is that the policies are landing significant impact over the market. It drives the demand and influences the future pricing. And recently, there are two movements. One is the CPI is taking action to hold the price. They release the estimate cost for the module and setting the bottom line for the module price and aim to curb the below price bidding that have affecting the solar industry. And the other part is that Chinese government recently cut the tax refund range for the exporter from 13% down to 9%. So in the end, forecasting pricing requires mostly and closely monitoring the China government and Chinese policies. And with these actions, along with the upcoming movement, we are expected that it will be a significant impact on the price trend. In this area of technology transaction, we are witnessing a rapid shift from PERC to TOPCon. As of October, in polysilicon and wafer sector, the N-type upstream polysilicon and wafer production already reached 80 to 85% that are using N-type. The phase-off schedule of PERC capacity during 2023 and 2024 has become a key focus for the market and for the players. And given the ongoing market downturn, it is clear that the PERC capacity will no longer persist. The China manufacturers began gradually shutting down the domestic PERC capacity in the third quarter in this year. And for the non-China overseas PERC production, particularly in the Southeast Asia, is also seeing a phase-out due to the tightening U.S. trade policies. We have continued to monitor the market dynamic to provide industry reference guidelines. But before back to India, for India market, we still observe many PERC capacity remain. And for this reason, I will talk about it in the later slides. And that thing for the Chinese market is that something I want to talk about the trend in module format and the power output. And of course, the impact on the Indian market. In the residential sector, we see that the current module size remains at 1.95 square meter. For commercial and utility scale, we are seeing a greater use of module with height of 2278. But after introduced the rectangular wafer in residential market, the module area increased by 2%, leading to a 10-watt increase in the power output. As for the commercial and the utility scale, with G12R wafer, the format expanded to 2382 millimeters, resulting in the 4.6% increase in module area and 25-watt increase in the power output. And we believe that this format is set to become the next mainstream option in the Chinese market. But what about in India? About India market, since we don't have to focus on the local shipment, and we don't have to we focus on the local shipment, and we don't have to worry about the container size, nor do we need to compare with the European 2 square meter policies. So because of this, I think the development of the rectangular wafer size in India will be much more diverse. And of course, in the end, the development of the rectangular wafers does make a game changer on the solar module. The slightly increase in wafer area leads a significant improvement in the power output, and which benefit the overall project yield rate. Well, finally, the second part, let's take a look at our market. The success of Indian market today can be largely attributed to effective government policy making and strong collaboration between business. And developing a local manufacturing base requires a well-coordinated mix of policies, and the carrot and stick approach have proved to be highly effective. On the one hand, India has leverage the national policies to accelerate renewable energy development, while implementing the productive measures. For example, the strict policy that earlier safeguard duties and the ongoing BCD duties. About the punish policies, anti-dumping investigations on China's aluminum frame and Chinese solar cell and modules have further reinforced this stance. And for the softer measures like the ALM list and DCR policies, they have moderately resist the Chinese import, creating room for the local production to thrive. And this is one hand. On the other hand, incentive policies such as the first and second phase of the POI has provided subsidies to local manufacturers. So among those different policies, interpret of the resistive and supported policies, those have made the rapid growth of India's local manufacturing abilities, enable it to take off successfully. And therefore, it is no surprise to see the rise of local manufacturing capacity in India. According to our data in 2025, the module nameplate capacity is expected to surpass 80 gigawatt, while the cell is projected to reach nearly 30 gigawatt. On paper, this nameplate capacity should be sufficient to meet the demand, and this is also why the Indian government they have recently announced that from April 2026 onward, the solar cell will be added to the LM list. And however, it is still a significant gap between the nameplate capacity and the effective capacity, or even the actual output. So we have some conversation with the local manufacturers. And when we talk with them, they point out some of the challenges, including a shortage of skilled workers, the lack of manufacturing experience, and the restriction on the Chinese visa. As a result, the process for ramp up takes longer than in the other market and longer than they expect. Additionally, we observe the significant imbalance in the capacity expansion across different sectors. While in module expansion, the plan is big, and for cell capacity expansion, it's relatively smaller. As for polysilicon and wafer, there are only a few manufacturers that are investing in this area. And these challenges highlight the complex of translating the ambition expansion plan into the real output. And those are something that the manufacturers should be aware of in the coming years. Of course, also we have received feedback from the developers during many visits. They have mentioned that efficiency and output of local product are not on par with the Chinese product. At the same time, local products tend to be more expensive. Therefore, beyond expanding the capacity and volume, we believe improving the qualities of local products is equally crucial. In earlier, we mentioned how the Chinese and global market are adopting the real fast with the technology like TOPCon, heat junction, and BC. However, in India, the market tells a different story. As for the local company, it is clear that not all of them are willing to invest in new technology. Of course, for the tier 1 leading players, they are expanding with the new technology. They introduce 16 busbar TOPCon modules or even moving to manufacture TOPCon cell by themselves. But on the other hand, many tier 2 and tier 3 manufacturers, they prefer to maximize the use of their existing production capacity. And due to the longer depreciation cycle compared to China, the small players, they are hesitant to invest in upgrading production lines. So as a compromise, they have shifted to use 10 busbar line to produce both P-type and N-type product. And this approach minimizes the investment while still making it to meet the market demand for the advanced technology. Here on the right, and we can see that the local cell capacity, nearly 50% of it is choosing PERC. And this trend is similar with the other solar cell and module manufacturing markets, such as Taiwan, Turkey, and US, where the PERC still hold a share of the market. On the left, we have the import data for Q1 to Q3 of this year. It shows that PERC sales still account for around 70% of total imports. And for the new technology, mostly is choosing TOPCon sales, making up around 28% of the import. While how the company's transition and align with the global trend will be a key focus moving forward. Another people has been asking about it is the export opportunity for the manufacturers beyond the domestic market. There is the price distribution chart for different markets. Generally, the market in India, the modules made in India using Chinese cell tend to have higher price due to the higher manufacturing cost, which make India market and India modules less competitive in overseas market. For the data shows the US is the #1 export destination for Indian modules. But however, because of the AD and CVD on China and on South Asia, Indian manufacturer export to US must use cell from other than China and other from those 4 countries: Malaysia, Thailand, Vietnam, and Cambodia. So thus we have seen the people using domestic cells and also cells from Laos and Indonesia for their module. And thanks to the US trade policy and the barriers imposed on Chinese manufacturers, the Indian players, they have the advantage when entering the US market. In this year, we have observed that several players that entered the US market, including Waaree, Vikram, Mahindra, and India-based First Solar. However, exporting to the US involved many complexity, particularly with the involving policies and stricter oversight from authority like US CBP. We have noticed that Indian companies export to US has started to face the investigation under the UFLPA, and which relate to the supply chain traceability in the past few months. And such policy shift can significantly impact the manufacturers and require careful navigation to maintain the access to US market. So due to the time constraint today, I'm afraid that I cannot be going through all the detail about the US market. But of course, we prepare a comprehensive analysis report on US market. And for this report, it provides a deep review on the key policy impact, possible entering approach, and the recent action by the customs authorities. It is designed to support the market, also to support the companies who is or willing to enter the US market, and for those planning to expand their manufacturing footprint in US, helping them better access the market and develop a strategy plan. So with our expertise, I believe that this report will be very valuable resource for the navigating the intrinsic landscape of US trading policies and the market dynamic. Whether you are looking to optimize your export or you are establishing the local operations, this guide offers the actionable insight to empower your decision making and ensure long-term success in the highly competitive US market. So that's all from my side. The presentation I shared today was created using the cross-reference data from our report. And if you are interested feel free to contact our sales team for more information. And thank you everyone for more questions. I'll be happy to discuss further. And you are free to reach out to me through email and WhatsApp as well. Ciao.
Hello everyone, I'm Robin. Today I'm here to talk about India's energy storage market and supply chain dynamics. Over the past 5 years, we have seen energy storage markets in China, the US, and Europe take off, driving rapid global growth. These 3 regions, now account for 90% of global storage installations. This raises the question, where will the next booming market be? Could it be the Middle East or India? Today, we will focus on the India market, exploring both demand and supply factors to see if India is ready to embrace rapid growth in the energy storage industry. Okay, today my presentation will be divided into three parts. The first part, we will provide an overview of the energy storage market in India. The second part, we will analyze the trends in the energy storage industry by looking at the current state of India's local supply chain. The third part, we will conclude with a summary and of some recommendations for the development of the industry. And now let's have a brief look at the India storage market. First, we are looking at the energy storage industrial development trends. We believe that the market is in its nascent stage, and the turning point of rapid growth phase is arriving soon. We believe that the demand for energy storage will grow gradually as the share of VRE power generation increase. VRE means variable renewable energy. Therefore, we will divided the development of energy storage market in 4 stages. As we can see in this chart, the China and the US have a share of VRE of 15%, and both countries have already reached a turning point for rapid growth. Meanwhile, most regions in Asia are still in the nascent stage of development. We expected these countries to enter the early stage of the energy storage market when their VRE share reached around 10% due to relatively limited grid infrastructure and less flexibility in their power system compared to China and the US. Demand for energy storage in these areas may origin earlier than expected. Currently, India's VRE generation share has reached 10%, and we believe that the India market is about to enter the early stage of the energy storage industry. We expect the installation rate to start accelerating soon. And to boost the energy storage industrial development, the government has introduced ambitious plans. The government has divided the development of the energy storage industry from 2022 to 2032 into 2 phases. In the first phase, cumulative electrochemical storage installations are expected to reach 34.72 gigawatt-hour by fiscal year 2026. In the second phase, cumulative installations are targeted to reach 236.22 gigawatt-hour by fiscal year 2031. According to our data, India's electrochemical storage capacity will come in at around 1 gigawatt-hour this year. So if India achieves its target by fiscal year 2031, this indicates a market potential of 200 gigawatt-hour over the next decade. And to support such an ambitious plan, the Indian government has introduced a serious introduction incentive aimed at driving the growth of the industry. Currently, there are 3 main policies in place. The first one is viability gap funding, which provides 40% subsidy on storage project deployment costs through a bidding process. This is intended to reduce battery storage deployment costs. However, the subsidy pool currently covers only 4 gigawatt-hours, and we anticipate the government will expand its scale. And second, the Power Authority has included energy storage in the power purchase obligation. The storage obligation requires that during fiscal year 2023, energy from solar and wind source utilized through storage system must make up 1% of total electricity consumption, increasing each year to reach 4% by fiscal year 2029. This will partially address the issue of energy absorption by storage stations. And third, the production-linked incentive includes National Advanced Chemistry Seal, with a budget of 181 billion rupees, and at achieving 50 gigawatt-hour production capacity for advanced chemistry sales, with a total subsidy amount of $2.16 billion for 50 gigawatt-hour, which translates to $43 million per gigawatt-hour. This is a strong incentive level comparable to China's industrial support. However, many conditions attached to this subsidy. For example, under the PLI, companies must start production and reach a 25% domestic value addition threshold to receive subsidy quarterly. This means that companies need to use their own funds for early stage construction. Lithium battery projects are capital intensive, so the high initial investments increase operational burdens, posing challenges for project sustainability. We can see that with ongoing subsidy incentives, energy storage auctions in India are gradually increasing. According to our data, the cumulative capacity of new battery storage auctions in the first 3 quarters of 2024 has reached nearly 15 gigawatt-hour, with a 150% increase from Q2 to Q3. We also saw a milestone in India's energy storage development in the first quarter of this year. India commissioned its first 100 megawatt-hour scale energy storage project in February, with a construction period of 18 months. And based on our data, 4-hour projects account for nearly 40% of total capacity, while 2-hour project makes up 60%. This indicates that India has higher demand for 4-hour battery storage compared to other countries. Also, we are seeing India explore alternative technologies such as flow battery and sodium-ion batteries, although these are only in the pilot phase. And considering India's policy and the progress of project tenders, we estimate that by 2030, annual battery storage installation in India could reach 5 gigawatt-hour. Of course, this is a conservative estimate. If policy support remains stable and the share of wind and solar power continues to grow, we expect the India market to experience rapid growth after 2026. In an optimistic scenario, India's annual installation could exceed 10 gigawatt-hour by 2030. Next, let's look at the energy storage supply chain. In terms of development chains, companies like Tata, JSW, and Reliance announced plans to build lithium battery capacity in 2023, as driven by the PLI policies. This year, 2024, we began to see India Energy Storage System company initiating capacity investments in storage system. For example, Good Enough plans to build 7 gigawatt-hour of capacity and then expand to 20 gigawatt-hour. This storage capacity is expected to become operational in 2025. Looking at the current state of India energy storage supply chain, we can say that lithium battery industry is still in its early stage of development. The battery project announced by Tata and JSW, for instance, mainly focus on EV batteries with limited involved in storage batteries. Additionally, we have analyzed the construction duration of battery factories. It is evident that the current construction period for battery factory in the US and Europe exceed 40 months. Even in China, which has rich construction experience, the duration is close to 20 months. In other words, India still needs to rely on overseas energy storage supply chains to meet its domestic demand in the short to medium term. Now let's look at the global energy storage supply chains. First chain, as we can say, Chinese manufacturers are now leading the energy storage sale market. In the first 3 quarters of this year, 9 out of the 10 global energy storage sale suppliers were Chinese companies. In terms of technology, LFP sale now hold a 95% market share. Meanwhile, the market share of NCM sales gradually shrinking due to stability and safety issues. The second trend is that, assuming no major changes in supply and demand, we expect the price of Chinese energy storage sales to remain close to the cost line in 2025. Manufacturers are likely to maintain their current pricing strategy, using relatively low price to achieve higher shipment volumes. And the third trend, we believe that in the short term, the competitive environment in the energy storage system sector is unlikely to improve. This is because the entry barriers for the system sector are relatively low, mainly due to its lower investment costs and shorter construction period. These factors have led to an influx of many players in the short time, resulting in significant oversupply. As a result, price for energy storage system in China have continued to decline, with price down 33% compared to the beginning of this year. We expect that, given the challenging competitive environment, price for China's energy storage system will continue to drop in 2025. The fourth trend is that, in the face of intensified competition, cell manufacturers are continuously working to increase cell capacity, aiming to improve product cost effectiveness. For now, leading lithium battery manufacturers in China have already begun mass production of 300 ampere-hour plus cells, and the penetration rate of 300 ampere-hour plus cells in the global large-scale storage market is nearing 40%. This rate is expected to reach around 50% by the end of this year. However, the more advanced 500 ampere-hour cells, which have gained interest this year, still need to be validated in the market. According to our data, mainstream global manufacturers have yet to start substantial production of 500 ampere-hour cells. Now, I will summarize the points discussed above and provide some recommendations for the development of India's energy storage industry. We can see a significant gap in installation capacity between India and the US and China. By 2025, the US is projected to install 60 gigawatt-hour of capacity, while China may reach 100 gigawatt-hour. In comparison, in the India market is just beginning, with new installation expected to exceed 1 gigawatt-hour annually by 2025. This large gap, highlights the potential of the India market. So, to support the growth of India's energy storage market, both the government and industrial partners need to focus on effective top-level design and a robust supply chain. For top-level design, there is a need to expand wind and solar installation continuously to increase renewable generation capacity, along with implementing strong and sustained policy incentives. In terms of supply chain support, India can leverage the Chinese supply chain to source high-quality, low-cost products to improve the economics of energy storage and expand the market in the short term. But in the medium to long term, India needs to build a local supply chain covering everything, from key lithium battery materials to energy storage system integration. Additionally, the government should promote technology diversification based on different application scenarios, encouraging the development of alternative storage technologies like flow batteries and sodium-ion batteries. Given the current weakness in the supply chain, the best development approach for now is to partner with leading overseas manufacturers to rapidly accumulate technical expertise. There are two main models. The first is to sign a technology licensing agreement with overseas manufacturers. Through paid technology licensing, India companies can achieve technology upgrade. In this model, India companies pay regular licensing fees to overseas company, which in turn provide ongoing technical support, personnel training, and assistance with later stage factory operations. The second model involves forming a joint venture with an overseas manufacturer through equity investment in technology. In this arrangement, both parties are closely linked to jointly explore the market. A feasible equity structure could be 51% for the India company and 49% for the overseas partner through technology investment. Once India has built up its technical capability, we anticipate that locally made cells and systems can be exported to the US, reaping the benefits of the US market growth, especially in the context of the US-China trade war. Okay, this concludes my presentation for today. Thank you for all your listening.